Howdy, Team 42. It's your skipper here, Darius Dale, to present our Around the Horn Weekly for Saturday, August 7th, 2021. As always, we have a lot of information to get through, so let's just get right into it. Starting with slide 3, the key takeaways. Deflation and inflation ended the week tied for the dominant market regime status, with 17 confirming asset market volatility adjusted momentum signals apiece, contributing to their respective 33% modal outcome shares of the total. For what it's worth, 17 confirming asset market VAMS is exactly half of the respective peaks for reflation and Goldilocks recorded 2 to 3 months ago, respectively. This relative lack of confusion in either of our two risk-off grid regimes, i.e. inflation or deflation, speaks volumes to the following two conclusions we outlined in Friday's leadoff morning note. Number one, the buy side's gross exposure is likely not elevated enough to catalyze a big ramp in cross-asset volatility in the near term, as per the still elevated level of signaling neutrality being observed via our global macro risk matrix, whereby 19 of the 42 indicators are neutral VAMs, with another 4 flirting with the return to that state, and those are the Russell 2000 MSCI Emerging Market Index, the Russell Volatility Index, and High Yield OAS. And number 2, the buy side's net exposure is likely not wide enough, i.e. to the long side, net long, to allow for anything other than a 3 to 5% correction in the S&P 500 at the current juncture, as per our crowding analysis, which continues to demonstrate healthy implied volatility premiums priced into the preponderance of risk assets. All told, we still believe Goldilocks has a chance of returning as the dominant market regime, but our assessment of the likelihood of that outcome has been ratcheted down due to the emergent risk of a September tapering catalyst. An upside surprise in July CPI next Wednesday would all but ensure that outcome. While we do not see any reason to amend our hybrid Goldilocks deflation portfolio construction at the top-down level, we do find it prudent to reduce our exposure to interest rate volatility on the short end and in the belly of the curve by selling 1 to 3 year treasuries, which is ETF SHY, and 7 to 10 year treasuries, ETF IEF. And then we're going to raise our deflation cash allocation with those sales, so not allocating anything inside of deflation. We are also keen to buy Ireland, which is one of the few economies we have accelerating really over the next several quarters, and Ethereum, which looks like it's on the precipice of a breakout here with the cash that we have already allocated to Goldilocks. So making some minor adjustments, but nothing really major in terms of the overall portfolio construction. Looking at slide 4, so this was our prior portfolio construction. The tickers highlighted in bold are what we added last week. So we added Eurozone, that was a big performer this week. Qualities, low volatility. Oil got smoked, in so much that oil got smoked. We had financials, best performing sector on the week. Had that 20% cash allocation ready to buy some more things, which we obviously did, obviously adding Ireland and Ethereum. And so slide 5, looking at our grid asset market backtest considerations. So obviously, so when we program this table, it's based on our expectations for the bottom-up macro regime cycle. What's growth doing? What's inflation doing? How's policy going to respond to that? Not necessarily what the market regime status is. The market regime will orient how we cobble together that portfolio construction from an asset allocation perspective in terms of how much exposure we need to have to equities, commodities, fixed income, and FX. But in terms of what we put in there, we obviously want things that agree with the economic and policy environment, because those are the factors that have the highest probability of trending from an asset market response perspective. So going back to this table, so obviously we expect deflation from a bottom-up macro regime perspective, i.e. what the economy is doing, top-down market regime, obviously what the markets are doing, and how we allocate ourselves from a portfolio construction perspective. But again, going back to what the economy is doing, got deflation projected for the balance of the year starting in September. We don't see very expedient slowdowns in either growth or inflation. It's denoted by the 0 sigma delta backtest contributing to the overall sample. Policy rate expectations, obviously we're not going to get anything there until they're done tapering, which they may not even finish. Debate's still out on that. We actually toggled policy back to tightening. Again, last week we thought, hey, look, Powell gave us enough dovishness in terms of his July FOMC catalyst or he set the stage for a much lower time horizon with respect to when the Fed might actually commence tapering. I would argue the July jobs report and Cleary's comments this week really walked that back in a material way. Obviously, most notably the jobs report. So we're putting tightening back into the system to program that and make the back test a little bit smarter there. And then lastly, obviously, we're going to be in a fiscal policy tightening phase for quite an extended period of time. We're not going to be able to just comp what we saw in Q1 and the early part of Q2 this year for again, we're going to have to go back in crisis mode to see something like that. And then lastly, we have most of the rest of the world, including the global economy itself, projected to be in bottom-up macro regime deflation for really starting, for the balance of the year, starting in September as well. So those are the considerations we're programming into the grid asset market back test through the blended annualized expected return, percent positive ratios, volatility, covariance. And we take those statistics and we plot them in scatter plot format on slides 6 and 7. 6, so we got the U.S. equities back test on the left, the global equities back test on the right. On slide 7, we have commodities back test, and then we dump them all into one chart. The portfolio construction candidates, sort of on the y-axis there, we're showing the blended annualized expected return ranking, and then on the x-axis, we're taking that risk-reward score. So the y-axis from we're taking the x-axis from the previous 3 charts and dividing it by the y-axis from the previous 3 charts to get a good sense of risk-reward. So this is kind of gives you a good visualization of the types of securities, asset classes, and exposures you should be thinking about adding. Now, again, we don't just go from the top down of the chart and say, hey, it's a top left, let's go at it. No, this is a starting point for the discussion around, okay, what's screening well from a volatility adjusted momentum signal perspective, what has catalysts from a policy perspective, and ultimately, and sometimes, obviously, you don't always get that opportunity, but what's signaling well from the perspective of its probable range. On slide 8 here, looking at our posterior portfolio construction. So I mentioned we're adding Ireland. Again, it's projected to be in bottom-up Goldilocks, i.e. growth accelerating, inflation decelerating for an extended period of time, really through the early part of next year. So we want to take advantage of that. And then Ethereum, again, looks like it's going to break out. Again, it's not, Bitcoin is yet to fully recover its bullish trend, but it looks like it actually could. So yeah, we're kind of eyeing that, but again, we like the setup from the perspective of our volatility adjusted momentum signal in Ethereum currently. So again, now we're down to 12% cash in terms of allocating those 2 4% positions, and then at the bottom we sold IEF, the 7 and 10 year treasuries, and SHY 1 and 3 year treasuries. So now we have 8% cash down there. So still hodling at 20% cash, no real change in terms of the cash allocation, but getting a little bit more offensively positioned in terms of increasing the risk inside of Goldilocks and getting a little bit less defensively positioned in terms of taking down some of the risk inside of deflation. Obviously, the jobs report was new. In terms of how you should react to information like that, that was a meaningful catalyst. Now, you don't go and just change the entire color of this pie chart and change out all 20 to 25 of these exposures on one catalyst. But you do need to adapt and react to changing market conditions and, more importantly, changing information, because, again, markets and economies are dynamic. And I would argue they've not been this dynamic since at least the early the middle of the 1910s when we're talking about the Spanish influenza. So let's understand that. Let's react to the information, but not overreact to the information. Again, we want to do things piecemeal because, again, we're never operating with perfect information. We're always open and trying to get incremental signals, incremental confirmation. We have a belief that Goldilocks is likely to return as the dominant market regime, but again, that belief has been ratcheted down in terms of our expectation of our assessment of the likelihood of that catalyst. But again, we still think it's coming. On slide 9, looking at our global macro risk matrix, as you mentioned, as I always mentioned, I like to do is how do we finish the week? Like what happened Thursday and Friday? The real big movers Thursday and Friday was the VIX went back to neutral VAMS, which itself catalyzed a bullish VAMS, a recovery to bullish VAMS in the S&P 500. Again, we've seen a lot of signaling and decision across a lot of the risk assets in the model over the last few weeks. That makes a lot of sense, just given the general amount of indecision we're seeing out there from a policy standpoint. And obviously, there's a real key sort of a misunderstanding, I would argue, at this point, but certainly over the last 4 to 6 weeks, a real sort of confusion around, okay, what's the ultimate economic impact of the Delta variant? And now we got his friend Lambda coming through town. So we'll see what the reaction function is in terms of policymakers' willingness to really impede economic progress as a function of the pandemic. I tend to think that neither Delta and Lambda are going to give you anything what we saw last spring. I think we're clearly out of the worst part of the pandemic, both from a vaccination perspective, but also from a political will perspective. Now you got to show your vaccine card to get food in New York, but that's probably as draconian as you're going to see it. On slide 10, looking at our global macro risk matrix, the market regime signals. So again, I mentioned deflation and inflation ended the week tied in terms of the total amount of confirming asset market VAMS. In terms of market regime probabilities, they're both tied with 31% modal outcome shares apiece on slide 11. So we still think this blue bar, this blue deflation modal outcome bar is likely to be a thin one. We think we're going to return back to the dark green bar. But again, what we think, you heard me say what we think, several times in that statement. And at the end of the day, it's really not about what I think. It's about what the signals are telling me in amalgamation. Okay, what's our market regime nowcasting process saying? What's our bottom-up macro regime forecasting process saying? What are our expectations on policy in terms of reading tea leaves from both monetary and fiscal policymakers? It's a full-time job. Obviously, I'm grateful for the opportunity to perform this analysis for you. But at the end of the day, we're not going to base our portfolio construction decision making around what we think. It's what we can observe through the lens of our forward-looking signals. On slide 12, positioning. So investor consensus got crowded. They crowded right into the short end of the curve at precisely the wrong time. You can see that with the 3 years east. So the net non-commercial length of the 2-year Treasury note futures, it basically almost 15,000 on Tuesday, and then obviously you got the jobs report. So that was kind of a tough raw deal. Obviously, we wore some of that. We're long SHY, so it's not like we're making fun of anyone but ourselves here. But I just wanted to call that out because you got to enjoy yourself. This job is can be stressful if you let it be stressful, but it's also quite fun. I get to wake up and think about the future every single day. I don't underestimate how how beautiful and beneficial that is to your psyche. You're constantly thinking about the future and trying to solve problems. It's a really awesome job. On slide 13. So I fixed this crowding chart. I feel like I spent 10 minutes explaining the crowding chart every week. So I finally just decided to help you guys visualize it in a much better format. And kudos to you, Adrian, for giving me this idea. One of the quant investors on Team 42. Anyway, so when you look at this chart, there's really nothing especially actionable, and obviously especially actionable would put you in the bottom left quadrant or the upper right quadrant. And junk J&K, junk bonds, high yield credit is kind of getting there. Or actually not kind of getting there. I would argue that's an extremely actionable signal. So are we willing to go buy junk bonds? Obviously, we did not do that. So we didn't do it. So, but it's clearly an actual signal for those of you who don't necessarily feel like you need to follow along with every single move we make. Obviously, some big boys and big girls out there. Go buy junk bonds if you want. You got the signal there on the screen. And then on right here, I'm talking about a potential for a reflation plane trade for weeks now. And part of the reason we said that is that, look, we're bullish on the market. We're bullish on the market. But the amount of dispersion we've seen needs to be reconciled. It's a record amount of dispersion, or near record rather amount of dispersion. You never see 3, 4, 5, even upwards of 6, sharp ratios on a month-on-month basis with just as many sectors down, 2, 3, 4, 5. I mean, it's banana 6 at the bottom. That's SPACs down there. It's like you don't see that trend for as long as it did. Basically from the second week of June all the way through now. And so that needs to be reconciled. Like investor, the market can only suffer that kind of dispersion pain over for an extended period. They cannot suffer that for an extended period of time because it probably means investors are eventually being squeezed out of positions by the mothership, by the risk management systems that a lot of these sort of multi-manager hedge funds. So we've been talking about this chart for a while and kept saying, hey, look, the market either needs to go down because the stuff in the upper quintile needs to chase the things in the lower quintile, or the things in the lower quintile need to start really recovering. Well, we said, hey, look, I think the probability is higher that the things in the lower quintile actually start really recovering, and that you see a broadening rally as the market returns back to a Goldilocks state, as the market regime returns back to a Goldilocks state. Maybe this is exactly what we saw on Friday. Maybe this is some version of that rather on Friday. I don't know that the dollar's going to go straight up, rates are going to go straight down in Goldilocks, but Friday really was a reflation day. And again, when we say dominant market regime, that word dominant is in there for a reason. Not every single day is going to trade like one of those 4 grit regimes, even though it could trend for a while. It's about what's dominant over an extended period of time. That's how you should be orienting your risk management from our perspective. Again, just one humble perspective. On slide 14. So is this the start of the reflation pain trade? I put some additional analysis in here this week to kind of get to the answer of that, is the answer to that question. Starting with the VVIX ratio, that is still sending a very positive message to market participants to keep dancing. The borrow phrase from our good friend Chucky Prince. I don't know if that E is actually real. I just put it in there because obviously it's very famous last words. A man from Citigroup back in 07, I think. Anyway, so looking at the high beta, low beta ratio, market still hasn't moved on there. That recently turned bearish VAMS. And again, you never know how thick or not thick the color of the bars in these charts are going to be. But as long as it exists, it's telling you that there's a decent amount more risk. So that's bearish VAMS is overbought. So again, is this the start of the reflation pain trade? Well, it's got to break the bullish VAMS unless because that overbought signal is real. On slide 15, small caps mega caps ratio, it's bearish VAMS overbought. Same with value growth. So the only way we can get a reflation pain trade is these things have to break the bullish VAMS to catalyze a widening of the upper boundary of the respective probable range. So can you get a meaningful sustained recovery in value relative to growth, or a meaningful sustained recovery in small caps relative to mega caps in the context of a decelerating economy? And I'll caveat this by saying we don't have the economy showing deceleration on a trending basis until September. We still have a G for Goldilocks, bottom up macro regime Goldilocks projected for this month of August. But we do believe in terms of our projections, which are born out of our stationary mean reversion model and agent-based and outcast model, the median of those forms the grid outlook that we have. It's saying growth is going to be ubiquitously slowing by September. Well, look at where the green is on these charts on slide 15 here. The green comes when your growth is clearly and cogently and honestly accelerating. So to me, I just don't know how you can get a real, sustained sequence of green in the absence of a, accelerating economy. I just don't know how you get there. On slide 16, everyone's like, well, you can, if Delta goes away or the fear of Delta goes away, you could really have a sustained relief rally. But I'm like, was Delta the reason you saw the underperformance of high beta relative to mega caps, the underperformance of value relative to growth, and ultimately the underperformance of small caps relative to mega caps? Sorry, they say high beta relative to mega. Sorry, high beta relative to low beta, small caps relative to mega caps, and value relative to growth. Was that the reason? I don't think so. I mean, you look at this chart, shows the Russell 3000 value index next 12-month earnings expectations, and it's been nothing but straight up to the right. And in fact, the momentum is actually increasing over the last several weeks. Like the 3-month trend hasn't changed. Like Delta had no impact on people's expectations for growth for value stocks. So you can't tell me that Delta was the reason value underperformed growth, that Delta was the reason high beta underperformed low beta, or Delta was the reason that small caps underperformed mega caps. No, the real reason on slide 17 was the FOMC signaling that they were not fully on board with MMT. That to me is the real reason cyclicals have underperformed since mid-June. When you go back to that mid-June meeting, the market was operating in a, man, these guys are going to be dovish forever state from, I don't know, let's call it early November, through mid-June. And their nominal GDP is going to run away, inflation is going to run away, and they're going to let this thing run hot until every Black and Hispanic person has 2 jobs. I mean, I kind of joke tongue in cheek, but they obviously have a maximum inclusive employment mandate, and that's clearly the thing that they have been focusing on for an extended period of time. But inflation knocked on their door and said, "Hey, man, don't forget about me." In terms of the upside surprises we saw in the May CPI report, no, it was April CPI, May CPI, and June CPI. So we got some pretty hot inflation prints, and so that obviously catalyzed a sense of uncomfortability around the equities building, around the table in the equities building there down in DC. And they said, hey, look, we got to actually have a conversation about where we have long-term interest rate projected, in terms of the dot plot. Let's raise, some people are like, no, this is ridiculous. This economy is roaring back, and jobs are coming back slowly but surely. Inflation's way too hot. We don't know if it's transitory or not. I'm just putting myself in their shoes. And they said, hey, we have to do something about, we have to signal to the market that we're not going to let nominal GDP, mostly driven by inflation, get out of hand. And that to me was a meaningful signal, because it said, hey, this Federal Reserve is much more like the one we're used to than the one we thought we had from November, through early June. The one from November to early June was clearly an MMT, it directionally shifted meaningfully towards MMT by changing its average mandate to average inflation targeting and by changing its employment mandate to maximum inclusive employment. And, this is their signal obviously catalyzed a meaningful decline in terminal Fed funds rate expectations, ironically, because it means they're not going to let the top go off in terms of nominal GDP. So to me, that signal was the real reason we've seen cyclicals underperform, because it said, hey, look, this economy is not going to run too hot. Therefore, the valuation, the prices I'm paying for a lot of the stuff that, oh, by the way, got super overowned, as late as, early June. Hey, look, we got to get back into some of this more defensive, disinflationary, digital economy type exposure. So it was really just a big repositioning. Part of it was probably fundamentals. Kudos to you if you nailed that. Our model signaled Goldilocks as early as, I want to say, June 10th or June 11th. You guys can fact check me on that, because again, we send out all the data every week. I'm sure you guys will catch me on Twitter if that was wrong, but I do believe that's when the model transitioned to Goldilocks, and clearly that was it was a very narrow Goldilocks, but two, it was a very meaningful signal, not only to us on Team 42, but to those signals in the 42 signals in the global macro risk matrix that are contributing to the Goldilocks nowcast. That's those. We're not the only ones looking at those 42 markets. Those are the 42 most trafficked in markets in the world. So when people started to see the amalgamation of the signals, they said, hey, no, we got to actually, we're accidentally underweight tech, digital economy type exposure. So people really put that trade back on in size. And I think, at least in terms of the last few weeks, I think you've certainly seen some people get stopped out of their reflation views, but maybe it comes back. But again, I just don't think that, I just don't know if you could have a sustained reflation trade without the economy sustaining an acceleration. We're very long in the tooth in that front. And it's very likely that by the end of Q3, everyone will agree that we're slowing. So that to me is kind of puts a wrench in that discussion. So again, I'm not saying value, small caps, and high beta are not going to outperform if we see a broadening risk rally. It's just that I don't know that they're going to outperform to the degree, and more importantly, for the duration that supports chasing them. That is the real key risk management conclusion from this discussion. On slide 18, so getting into the chop of the wood part of the discussion, S&P 500, that's back to bullish VAMS. 4,500 is in play on the upside. WTI, that was perfectly overbought last Saturday. We said, hey, we're adding it. It's overbought. Dollar cost average. I could have been more clear about that. Now it's perfectly oversold. So if you didn't dollar cost average, now you can go buy it with two hands. Two hands, please. Pour some crude oil in my hands. That probably won't be a very good idea. All right, take that back. On slide 19, looking at the US dollar, perfectly oversold last Saturday, perfectly overbought today. What did I say? I said, hey, look, the dollar is perfectly oversold. We might have a commodity risk off week. I said crude oil is overbought. We're probably gonna trade off this week. Certainly didn't see it going down 6%, but well, that is what it is. I mean, actually, no, time out. This thing went directly to its lower boundary of power range. So I apologize. We actually did see it going down to 6%. I apologize. The math works, folks. Math is better than marketing. Looking at the 10-year break even on slide 19, that's still bearish VAMS. I mean, things not really moving, but it's still bearish VAMS. So as long as that signal is intact, that is guiding our expectations on inflation, on duration risks, and things of that nature. On slide 20, looking at the nominal 10-year, that's still bearish VAMS, traded right to the upper boundary of its probable range in Friday's jobs report. I said, look, man, this thing's not going higher than 130. That's exactly where it closed, literally to the decimal. Look at that, 1.3. Like the Excel took out the zero because it doesn't even display the zero because it's perfectly to the decimal. So we'll take that. High yield OAS, that's narrowly bullish VAMS. Again, this thing's been back and forth for a while now. It's the signal line, the price regime signal line for high yield OAS, as I believe 333 basis points. We closed at 336. I don't know if that's a meaningful bearish signal, risk off credit signal. I just think that it's been consolidating for such a long time, as have many market exposures, that the signal lines have really come very close to the local price regimes. It's all about the relationship between the medium term price regime and the local price regime, the medium term volatility regime and the local volatility regime. And notice I keep saying regimes. I'm not talking about moving averages. We're talking about calculating medians and understanding the shape of the distribution, based on our observations of the length and the duration of the trend. It's all systematic, but there's a little bit more math than I think moving average crossovers, which I'm not this, I'm just a guy sitting in the room. If you can make money with whatever, I don't care if it's banging a gong. If you can trade at banging a gong, all power to you. I'm not here to make fun of anyone's trading strategy. That's I think it's rude and disrespectful. On slide 21, defensives. Getting into the real wood. Okay, let's look at the review of the portfolio construction. Defensives, they're bullish VAMS, not actionable. Mega cap growth, that's bullish VAMS, not actionable. Size, slide 22, that's neutral VAMS, not actionable. Real estate, that's bullish VAMS, not actionable. Slide 23, looking at healthcare, that's neutral VAMS, not actionable. Slide or Ireland, we're adding Ireland, so that's bullish VAMS, but it's a little bit over. It is overbought. So same situation with crude oil. Hey, don't hop in there Monday and buy it with two hands. You start dollar cost averaging, and crude oil was a perfect example. Say, hey, look, it is overbought. We're adding it. We want this exposure, but it's overbought. So look, let's dollar cost average it. I think you got a phenomenal opportunity to buy crude oil this week, particularly in the latter part of the week. As it closes at the lower boundary of its probable range, maybe we see something like Ireland, or maybe we get a gift. Ideally, we want to buy things when they're down. But again, who knows? You never know. You never know ex ante. It's impossible. The word no implies you can't know ex ante by definition. On slide 24, Ethereum, that's neutral VAMS. It's overbought. Same deal with Ireland. Same deal with crude oil last week. You can't go on there with two hands if it's overbought, but you definitely want a dollar cost average. But we're adding it because, again, you want some exposure at the bare minimum, because there are things like the financials, which were, I wouldn't say they were overbought last week, but they certainly weren't necessarily, perfectly actionable. Then boom, big move this week. On slide 20, or sticking with slide 24 here, Eurozone, that's bullish VAMS, not actionable. Quality on slide 25, that's bullish VAMS, not actionable. Same thing with low beta. Slide 26, crude oil's bullish VAMS. Now it's perfectly oversold. I mean, just ping pong in that probable range there. Financials, neutral VAMS. Now they're overbought. Again, don't chase this stuff. 10 years right at the upper boundary of its probable range. Financials right at the upper boundary of its probable range. Are we going to get a sustained reflation pain trade? I just don't see it. I think you can definitely see, some more drift on the long end of the curve and higher. See some more meaningful drift in some of these overs. I think the pain trade is likely to be more concentrated in the equity market, because you've seen that record dispersion. Like, it's just been mind-boggling how much dispersion we've seen over the last 6 weeks. I cannot stress that enough. And so that is in and of itself a catalyst to see, a broadening sort of reflation type market. But I don't think you're going to see a reflation type market where tech's down like it was Friday, NASDAQ's down like it was Friday, because I just don't see the upside in long-term interest rates like you would normally have in a bottom-up macro regime of reflation. We're running out of that gas, in my opinion, or at least in our model's opinion. On slide 27, Barclays Ag, that's neutral VAMS, oversold. Same thing with extended duration treasuries. 28, EM dollar debt, that's bullish VAMS, it's oversold. Gold was an interesting one. We talked about this on Twitter, so I don't want to sort of spend too much time on it. But again, it's kind of right at it's right at its price regime signal line. And so if this thing breaks down a little bit lower, then it's going to go to bearish VAMS. It's going to open up the downside of its probable range. And of course, what we're going to do on that, we're going to sell it, because we don't like to be long bearish VAMS. Bearish VAMS tend to amplify the volatility. Again, when you see these back tests, by the way, all that's being backtested. So you see that at the top of the gold chart. Mean 22-day forward max drawdown when VAMS is bullish, minus 1.9%. Mean 22-day max drawdown when VAMS is bearish, minus 1.3%. The model is instructed to backtest. It's instructed to identify the level of volatility with which the asset, the price, has higher drawdown risk. When you see it has lower drawdown risk in bearish VAMS state in this backtest, it's not because it has lower drawdown risk. It's only because in that duration. These are 3-year charts. If I pull the chart back as far back as we train the back test, you're going to see obviously that it's a different outcome. But again, so I just want to spend some time on that, because sometimes it might be a little bit confusing. Although I will say, for volatility specifically, volatility takes the trampoline up and the elevator down. So you tend to see more drawdown in bullish VAMS regimes. The good news is our models are perfectly great at predicting the transition from bearish or neutral to bullish VAMS for things like volatility, credit spreads, and stuff like that. So that's obviously that's why we have all those things in the global macro risk matrix that we review every morning. Keeping it moving here on slide 29. IG credit, that's bullish VAMS, it's oversold. 5 to 10 year tips, that's neutral VAMS, they're oversold. Obviously, most things fixed income in the week oversold as a function of that jobs report. Is that the new trend? Are we going to go back to bottom up macro regime reflation and just stay there indefinitely? Highly unlikely, very highly unlikely. But again, I could be we could be wrong. This is all probabilistic. We're just talking about the modal outcomes and things that are close enough to the modal outcome that they need to be allocated to in risk terms. On slide 30, wrapping up, 20-year treasuries neutral VAMS oversold, US dollar neutral VAMS overbought. Let's see how the next week ends. A lot of stuff's oversold, a lot of stuff's overbought. I think we have a pretty interesting setup next week, particularly in and around Wednesday CPI report. Again, the economists have it ticking down. We have it ticking down. But again, I think an upside surprise really does catalyze, really just takes that Goldilocks, the probability of Goldilocks returning as the dominant market regime. I think that takes it way down to something close to zero. Who knows if it's reflation that comes back? I highly doubt it. It's got, what does it have? Sorry, let's go back. Reflation has 6 confirming asset market VAMs at the moment. I don't think that's a real hope in heck to really get back up there in terms of dominant market regime. So ultimately what that means is if we see an upside surprise in CPI, we're probably going to get a little bit more confirmation of either deflation or inflation from a dominant market regime perspective, which would obviously amplify the probability that we see some risk off market conditions. So we got 20% cash. We expect to use it to buy stuff in Goldilocks, but if it doesn't happen, we got 20% cash that'll protect us from the from a potential onslaught from inflation and or deflation. And obviously we're mostly adequately positioned from a sector and style factor perspective. And then obviously very well positioned from a overall asset allocation perspective in terms of our relative exposures to the different asset classes. So with that, this is your skipper. Excited to present our Around the Horn Weekly for Saturday, August 7th. Thank you for participating. God bless. Have a wonderful week. Cheers.